real estate, it is the greatest investment vehicle of all time. You get tax benefits of owning it. You get appreciation. It generally goes up over time. It spits off cash flow every single month. And you get to supercharge your returns with debt. This, in my opinion, makes it the greatest investment vehicle of all time, and it has generated more millionaires than any other opportunity vehicle. However, there is one problem that we've all kind of been lied to about, the myth that real estate is a passive investment. And you can see here, this is actually a study done by NAR, which is the National Association of Realtors. And this study found that on average, a property management company spent about 12 hours per week on a single family home, which is crazy. There's lots of different tasks, but tenant screening, rent collection, maintenance coordination, and legal compliance. So yes, real estate is absolutely the best, in my opinion, investment that exists. However, the lie is that it's passive. It's totally not passive. So that's kind of the challenge here. So depending on your goals today, what I want to talk about is maybe there is a better way that actually is passive. Maybe there's a better way to invest in the real estate without dealing with the tenants and toilets. So again, the problem is that real estate is freaking amazing. The challenge though is that there is a learning curve. It's not like you can it's not like just buying into the S&P 500, just dollar cost average, don't never look at it. It's a little bit more complex than that. And it's not passive. Again, there's tenants, there's toilets. Even if you hire a property manager, which first of all, they're going to take 10% of your rent, even if you have to stay on top of them, you're managing them. They're kind of like one of your employees. And you have to be interfacing with them, making sure that they're not slacking on the rents and they're doing a good job on the repairs and the reporting and tax documents and stuff like that. So even if you hire a property manager, still not passive. So people want to diversify out of things like the stock market, casino, but again, real estate can be intimidating and it has those barriers to entry. Or they don't have time or the expertise to invest in real estate. So the solution, this is what we're going to get into in this video. And again, depending on your goals, there might be two really good options for you here that truly is passive and you can, overcome those other hurdles. So the proof, who am I? I'm definitely not like Grant Cardone or anything like that, but I have been investing in real estate for over 5 years now. I have 12 or 13 units that I self-manage, all out of state, so I'm not even in the same state. It's been going pretty successfully. The promise of this video here is to show you, again, two passive options. In the plan, I'll kind of help you decide which route might be better for you, and a 3-step process for identifying an opportunity. Okay, so option 1 here. This is going to be lending, so becoming a lender for real estate transactions. So you can do this 100,000 different ways. There's lots of different styles here, but you can look at maybe like short-term lending. Maybe if your goal is to kind of turn your cash and maybe be a little bit more on the active side, meaning you might have to turn your cash every 3 to 6 to 9 months. But you'll potentially also get higher returns, right? Because you're going to get that interest rate and then probably some sort of like fee or points up front. So this might be for someone who is lending money to a fix and flipper, where you give the fix and flipper some money, they go out, do their thing, sell it, give you your money back. And then you kind of repeat every 3 to 9 months. So not truly passive, but if it's once every 9 months, it's pretty passive. Or also you could do transactional lending. So this is even much shorter term. I just wanted to throw it out there just so everyone's aware of it. But there are lots of situations when people just need money for like one day, and that's a transactional lender. So the cool thing here is that it's kind of can be low risk if you do proper due diligence. You turn your money extremely quickly. Or you could be more of a long-term lender, which this is much more of a passive option. So what you could do, like for example, I have lots of lenders on my properties where we've agreed to, an interest-only loan, right? So they give me X dollars, and now they just get straight cash flow every single month. And if they ever want their capital back, they just let me know, give me a little bit of time, I replace them, give them their capital back. But as long as I'm holding it, I just am constantly spitting off interest-only payments to them. Alternatively, you can do an amortized loan. So this would be more similar to kind of like what a bank does with there's a scheduled plan for getting paid off. Like a 30-year amortization loan is is basically scheduled. The payments are set up so that the entire principal balance is going to get paid off in 30 years. So that's another option. Uh, and again, here there's kind of no rules. That's the beauty of it. You negotiate the terms so that whether that's the term length, how long you want your money in the deal, the return, what interest rate you want, what points you want up front, and also how much of the project you're willing to lend on. So that's LTV essentially. So if you want the investor to have some skin in the game, like you're not going to fund 100% of everything, that's you can decide that, and maybe you're going to have less risk if you are willing to lend on lower LTVs. So the pros of going this route, is giving money to an investor, letting them do their thing, and letting the investor just kind of pay you. The pros here is that it can be a little bit lower risk than option two, which we'll get into, provided that you do good due diligence and that you're lending to an investor who has a track record and the deal's a good deal and everything like that. And also another big pro is it's very stable and predictable returns. So one issue some people have with the stock market is it does like this and it goes down, it goes up and down. If you're getting predictable interest only payments, it's like your bank account goes in a straight line up, which is kind of nice. Um, the cons, though, is that when you compare it to option two, also you're kind of capped on how much money you can make. It's already like a predetermined amount of money that you're going to make, which, again, depending on your goals, maybe that's fine. Maybe you're just looking for the lowest risk, most predictable return. If that's the case, maybe option one here is the best for you. Now, getting into option two, so this is equity investing. And this is a little bit different. So instead of you lending money to an investor, where you're getting like a promissory note and a deed of trust, that's option one. In this situation, you're also going to be on title. So you're not lending money to them. You're physically investing in the deal with them. And this can be kind of in two main categories, I would say. So first is one very common way is like apartment syndications or just syndications in general. So what a syndication is where lots of investors pool up their money essentially and they invest in a deal with an operator. So the investors are all passive. They just kind of get reports from the operator, and the idea is that you write the operator a check and they write you bigger checks back. So that's a syndication. You pulling your money up, usually buying some big building, an apartment building, something that might be difficult for just one person to afford. Also, you could be a private money partner. So this is much more common on maybe like smaller deals. For example, I have one project. It's just like a single family house, and the partner I brought in with the money, they didn't really want to be a lender. They were interested in a little bit higher returns. So instead, now their name is on title with me. We're both of our LLCs are actually on title, and so we're essentially partners on the deal. And again, it's similar situation. You still negotiate the terms, the term length. Maybe this is the business plan going into the deal. So the term length meaning like, hey, are we going to just hold this forever? Like, are we going to sell it after 5 years? Is this going to be a fix and flip where we sell it after 3 to 6 months? That's kind of negotiating the term length up front. And you can also negotiate the returns up front too. Like, hey, how much equity am I going to get if I bring $50,000 to this deal, $100,000 to this deal? I want at least X percentage equity, or however you want to structure that. The pros to this method is that you do have a higher potential for return. So you're participating in the upside of the deal. So real estate investments can have crazy high upside, and you're not capped to like the loan that you gave the investor, right? So if the deal does crazy good, maybe you can get a lot of returns on one deal. Another huge pro of doing it this way is that you also get the tax benefits of owning the real estate. So you can, you get the depreciation against your income, or the other various tax benefits, especially if you're a person who ends up paying a lot of money to the government. This could be extremely beneficial to you as well. And then another con, though, or one con of doing it this way, though, is there is a risk of loss. So you're not just like a lender anymore who's saying like, hey, here is the returns I'm getting. Now you're kind of participating in the upside, and then if the deal goes bad, you're kind of participating in that as well. Another potential problem too is anytime your name is on title of a property, not anytime, but let's say you're a private money partner on a deal, and somebody breaks their leg or whatever and tries to sue. Your LLC is on title too. Maybe they come after you. Maybe it's a nonsense lawsuit, but still your name is on title. Not so much with syndication deals. You're kind of uh, not so much at risk there. But if it was a smaller deal and you're a private money partner, something to consider. So the three-step process here for identifying an opportunity. So step number one is you do need to decide if you would prefer to be an equity partner or just a lender, right? And again, that depends on your own personal risk tolerance and how much returns that you're looking to achieve. Again, if you really want those tax benefits and you really want to participate in the upside, equity is going to be your play. If you want to be a little bit more conservative, a little bit lower risk, but you understand that, hey, I'm not trying to make 25% returns. Like maybe lending is going to be a little bit better fit for you. So once you decided if you'd rather be an equity partner or a lender, the next step is to identify an operator. And don't go looking for a deal, go looking for an operator. Uh, the operators that you're going to want to be looking at, it's huge that they have a track record of success. Do not just pick somebody because you like them or it's a friend of a friend or something like that. You definitely want to do your due diligence here because this is going to be the greatest variable to if you get your money back or not is the human being running the show. They're going to know a lot more about the deal. They're going to the one be in charge of making decisions and doing the operations. So you're more so investing in that human than you are the real estate deal. You are investing in both, but look at it as you're investing in the human first and the deal second. So things you're going to want to look for is you're going to want to get other investor references. Another super key thing that not a lot of people talk about is get professional references. You talk to their accountant, their lawyer, their property manager, or their contractor. This kind of has a big advantage of this is just a professional in the field. They really have no reason to lie to you. They're going to be very honest and blunt and tell you about their experience with this individual. Now, you want to look at past projects. Maybe they have them on their social media, or you can ask for them. You can also ask for HUDs or closing statements or whatever. Just the proof that they're actually doing these transactions. So once you have decided if you want to be an equity partner or a lender, you found a good operator that you want to partner with. Now you want to hire an attorney to draft up the documents. So you definitely don't want to do like any handshake deals or copy and paste documents off the internet or anything like that, because that could be kind of a recipe for losing money. Assuming you do a perfect job vetting the operator, then this number 3 is almost irrelevant. But you want to act like you want to have ironclad documents, iron client protection and everything spelled out, and then put that document away and then never ever have to look at it. But assuming something does go south and you have to pull out the documents and take a look at them, you want those documents to be rock solid, right? So you want to have everything lined out, and a good attorney is gonna know all this. But you want to have things in there like what happens if either party fails to follow or fails to execute on their agreed upon duties, right? What if one partner backs out? What if you don't actually give the money when you're supposed to? What if they just like bounce town or take your money and move to Sweden? Like you want to have what happens laid out. You also obviously want to have laid out exactly who is paying for what and how the profits are going to be split. So that being said, if you are looking to invest, I'm an operator. So if you're looking at my social media and you see my projects and you think this might be something interesting, you want to be an equity partner or a lender, click the link in the description and let's hop on a call and have a coffee date, lunch date, whatever. We'll hop on Zoom, meet each other. And this is totally no pressure. You want to make sure you're a good fit for me. I want to make sure I'm a good fit for you. And if it is, we'll look at some opportunities. And if it works, let's make some money together. So I'll see you guys on the next one.